Hello, everyone. In the world of business mergers, what if a company's biggest liability, we're talking about its past losses, could actually become its most valuable asset? Well, today we're going to demystify Section 116 of the new Income Tax Act 2025 to find out exactly how that's possible.
So let's get right into it. Imagine you're advising a profitable company that's looking to merge with another one, but this other company is sitting on some pretty significant accumulated losses. The big question, the one everyone wants to know, is this: can we actually use those losses to create a future tax asset? Section 116 has the answer, but trust me, it's not a simple yes or no.
And that brings us right to the heart of the matter, Section 116 of the Income Tax Act 2025. You should think of this section as the official rulebook. It's what determines whether the losses from the company being acquired can be legally used to shield the profits of the new combined company.
So you might be asking, why do we even have this rule? Well, it's a bit of a balancing act. On one hand, the government wants to encourage genuine mergers that can save a struggling business. But on the other hand, it has to prevent what are essentially shell games. Mergers designed purely to buy up tax losses without any real business purpose. Section 116 is that tightrope walk. Now, for all you seasoned professionals out there, this whole structure might feel pretty familiar, and it should. Section 116 of the 2025 Act isn't some brand new, radical idea. It's really an evolution of the old Section 72A from the 1961 Act. The core principles are the same, which is great because it gives us a sense of continuity.
Okay, before we dive any deeper, let's make sure we're all on the same page with two key terms, and these come straight from the law itself. First, accumulated loss. This is the business loss and, really important, excluding any speculation losses that the original company could have carried forward. And second, unabsorbed depreciation. That's just the depreciation it hadn't gotten around to claiming yet. These two items are the valuable assets we're trying to transfer.
Right, so it's definitely not as simple as just merging two companies and poof, your tax bill disappears. Not at all. Section 116 lays out a pretty strict eligibility checklist. It's a series of hurdles that both companies have to clear to get this benefit. So let's unpack those conditions.
Think of it as a multi-stage gauntlet. First up, the loss-making company has to prove it was a real, substantial business. That means being in business for at least 3 years and holding on to 75% of its fixed assets for the 2 years right before the merger. Then, after the merger, the responsibility shifts. The new company has to hold those same assets for 5 years, continue the same business for 5 years, and, this is the big one, it has to hit some very specific production targets.
So, what is that magic production target? For that, we turn to Rule 60 of the Income Tax Rules. It states that the new, merged company has to achieve and maintain production of at least 50% of the original company's installed capacity. Basically, the maximum that factory or business could possibly produce. This is not a suggestion. It's the key metric that proves a real business turnaround is happening.
And yes, there's a deadline. The clock starts ticking on the day of the amalgamation. The new company gets 4 years, until the end of year 4, to hit that 50% capacity goal. But it's not over then. It has to keep it at that level all the way through the end of the 5th year. This is to make sure the revival is sustainable, not just a short-term trick.
Okay, the theory is one thing, but what does all of this actually look like in practice, on a balance sheet? Let's run through a quick case study to see the real financial impact of a Section 116 amalgamation when it's done right.
So, let's meet our two companies. We have Profit Co. Limited, a healthy business with a taxable profit of 10 crores. And they're acquiring Loss Co. Limited, which has 8 crores in accumulated losses and another 2 crores in unabsorbed depreciation. You add those up, and that's a potential 10 crore tax shield. Let's assume they merge and they do everything by the book, meeting all the Section 116 conditions. All right, in their very first year after the merger, the new company makes a profit of 5 crores. Now, because they've ticked all those compliance boxes, they can start using that pool of brought forward losses. They use 5 crores of the loss to completely wipe out their profit. And the result? Their taxable income for the year is 0. That's a huge direct cash saving.
Let's move to year 2. They still have 3 crores of business loss left to use from that original 8 crores. This year, business is even better. They earn 6 crores. So they apply that remaining 3 crore loss. And just like that, they've cut their taxable income in half, down to only 3 crores. And don't forget about that 2 crores of unabsorbed depreciation. Unlike business losses, which eventually expire, unabsorbed depreciation can be carried forward forever until it's fully used up. That's a fantastic long-term benefit. Now, actually getting this tax benefit isn't just about the operations. The paperwork, the procedural compliance is every bit as important. And honestly, this is where a lot of companies can get into trouble. So let's look at the fine print. You know, all of this operational work, hitting production targets, continuing the business, it all boils down to one absolutely critical document, Form 29. This is not just a form you fill out. It is your official declaration to the tax authorities that you've done what you promised. Without filing this correctly, the entire benefit can be denied. So who files it? The new amalgamated company does. And when? You have to file it with your tax return for the year you first hit that 50% production level, and then you have to file it again for every single year after that, all the way up to year 5. It's all done electronically, and it needs 2 levels of verification: a digital signature from a company officer and a certification from an accountant. So what's the biggest mistake people make? By far, it's failing to maintain those production levels for the full 5 years, and the penalty for that under subsection 5 is severe. The tax department will retroactively take back every single rupee of tax you saved. That whole amount becomes what's called deemed income in the year you messed up, creating a massive sudden tax bill. Now, there is a small escape hatch. If you have a genuine hardship, you can apply to the central government to ask them to relax the conditions. Okay, we've covered the law, we've walked through the conditions, and we've talked about compliance. Now, let's just boil this all down to the absolute essential takeaways that every professional needs to remember when dealing with an amalgamation. Here it is, your Section 116 playbook. First, always remember the purpose. This is for real business revival, not just creative tax planning. Second, those conditions are strict and non-negotiable. The business history, the 75% asset rule, the 5-year continuity. Third, that 50% production target is your make or break metric. Fourth, all your proof lives in one place, the timely filing of Form 29. And finally, never forget that failure is expensive. Any benefit you claim can be taken right back and turned into taxable income. So, I'll leave you with a final question to think about. The next time you're structuring a merger, look past the numbers. Ask yourself, is this deal truly set up for a genuine business revival, or is it just about getting some short-term tax relief? The answer to that question is everything. Thank you so much for joining me for this breakdown of Section 116. If you found this useful, please hit that like button, subscribe for more explainers, and share this with anyone you think might benefit. Just a quick reminder, this explainer is for educational purposes only, and it's not professional advice. Tax laws can and do change, so please always consult with your professional advisor before taking any action. This has been an AI-generated educational guide.